We'll start question on consolidation. So always first thing you should keep it in mind, read the requirement carefully, and then of course you can jump into the question. Prepare consolidated statement of financial position for company P at 31st December 2019. Explain the rationale behind elimination of intragroup balances and unrealized profit in relation to sales made from a parent to subsidiary company. So 18 marks is your consolidation and 2 marks is the theory again. So always keep a habit of highlighting the important part of your question. First, July 2019, P acquired and paid $100 million in cash to acquire 80% of Scottish company. Always important, date of acquisition, never forget. Financial statement was prepared by PNS on the date of 31st December 2019. So now the point here, is this a full year acquisition or a mid-year acquisition? Chalo, perfect. So this is not a full year acquisition. We acquired a subsidiary company on 1st July and financial year is getting over on 31st December. So exactly we have a post acquisition period equal to 6 months. So let's read the financial statement. We have a non-current asset, property, plant and equipment. We have a investment. We have a current asset comprises of inventory, trade receivable, cash, total assets, equity, retained earnings, NCL, CL, total liabilities. Now we'll read adjustments one by one. The fair value of Scottish company's net assets were equal to carrying amount with exception of its head office. This office had a fair value of 12 million in excess of carrying amount. So there is an adjustment, fair value. I'll highlight it. And the date of acquisition, which has a remaining life of 10 years. So there will be fair value depreciation as well. So I need to highlight fair value depreciation. Sure. Second adjustment, on 1st July 2019, P company also acquired 40% company A. That is your associate company. But of course, we don't require financials of associate because we only have to show one single item as associate company. P company paid 30 million in cash. In addition to this, P also issued to the previous owner of A company 30 million shares in P company. So we are not giving just cash to acquire a subsidiary company. You are giving shares also. Plus your parent company is giving the shares of parent company to the associate company shareholder at a market value of $2.3 each on 1st July 2019. So on the same date, we acquired two companies. We acquired the same day, 1st July, parent company acquiring subsidiary company plus parent is acquiring associate as well. Total consideration exceeds group companies Engel's net assets and Parsley's has only recorded cash consideration. So about share exchange, they have not mentioned here. S company made a loss of 10 million for the financial year 31st December 2019. Subsidiary has made a loss. So it will be split between parent companies plus the shareholder and including NCI. A company has made a profit of 6 million for the period. Very good. Associate is a profitable company, but subsidiary was the loss-making company. P and S both hold equity instruments. No election has been made for the classifying as fair value through OCI income. At 31st December, they have increased by amount of investment 15 million and 3 million respectively, but no entries has been made to reflect this particular accounting. So when entities are not using IFRS 9 equity instruments as OCI, the primary condition says we have to use fair value through P&L account. Now let me ask question two quickly. Dimple, can you tell me how do we make accounting treatment fair value P&L for IFRS 9 equity instrument? How do we make accounting for IFRS 9 equity fair value through P&L?
Sir, you're asking when we issue shares, like the extra shares that are being issued, how do we account that you're asking?
When the entities are purchasing shares as an investment and company has designated fair value through P&L, how do we make accounting?
Yes, sir.
So how do you make accounting treatment when entity has chosen for equity instrument under IFRS 9 fair value through P&L?
Sorry, sir, your voice was not clear. Can you please repeat?
So my question was, if you are purchasing equity instrument under IFRS 9, how do you make accounting when instrument is fair value through P&L and not fair value through OCI? So whenever entities select the accounting treatment fair value through P&L, so any gain or loss in the fair value changes will be reported in P&L account, as simple. But when companies select the option of FVOCI, every losses and gain will be part of OCI. And transaction cost will be capitalized under OCI and transaction cost will be charged to P&L. Exactly. Chalo. No entries has been made to reflect all of these gains in the P&L account. But I hope now it is cleared. Those who were not sure about the answer. Okay. Next adjustment. Scottish and Associates have both sold goods to the Parsley company for many years. None of these goods remained in the group. Thank you so much. We are lucky. There is no unrealized profit in the books of accounts of any of the entity. Parent company's financial statement shows there is a 5 million payable to Scottish company. In the books of parent company, amount is shown as payable to subsidiary company. This is not agree with the receivable balance in financial statement of Scottish company. So parent is showing 5 million payable to subsidiary, but subsidiary is showing something else. Scottish company is showing due to 2 million payment made by Parsley on 30th December 2019. So we got an adjustment of 2 million, which is called cash in transit. P company value NCI on 1st July, which is valued at $29 million. So I can highlight this also. The fair value of NCI has been given to us. So once I marked all things as important, I need to start presenting my answer. I'll make it the bigger one. Okay, that's perfect. Consolidated statement of financial position as at 31st December 2019. How the figures are given? Our figures are in thousands or in millions. All the figures are in thousands. So I can use a column here. Dollar thousands. I'll strictly follow the format according to the question itself. So first is non-current assets. Followed by investment. Investment in associate company. Let me check the name of associate company. Angus company. I should use working note number 6. Goodwill, working note number 3. Current assets. Under current assets, we have a breakup. Inventory, trade receivable, and cash. I'll leave one line. Total assets. We'll leave one line. Equity. In this, we'll take ordinary share capital. This time we have a share premium balance also. We have retained earnings. We have NCI, which is coming from working note number 4. We'll leave one line. Non-current liability. We have current liability, and I hope there are no bifurcation in CL. We have a trade payables. So under CL, trade payables, and the next comes total liabilities. So first thing, always keep a habit of making the standard format. And once standard format is done, I'll mark it 2 digits as decimal. So if any figures are in decimal, I want to convert into 2 digits post decimal. And I'll make it slightly bigger one. Chalo, perfect. Once format is done, start making your working notes. Working note 1, P acquired S on 1st July 2019. We acquired what percentage? 80%. 80%. So that's standard working note we have to follow as working note number 1. Working note number 2, net assets of S. And we'll use the column at acquisition, at reporting, and the next is post acquisition. Okay, so I'll make it visible for all. Okay, so we should start with share capital first. Share capital of subsidiary company. Share capital, it is 40,000 and rule says this does not change. 40,000. Reporting also 40,000. And post acquisition will be reporting minus the acquisition. The balance is 0. Followed by retained earnings. Now retained earnings on the date of reporting, it is 81,700. Now, of course, I need to calculate how much was the retained earning on the date of acquisition. So first of all, I need to go and check the question. As a subsidiary, we made a loss of $10 million. Now, you need to understand when the companies are making loss, but rule says every revenue and expenses will accrue evenly throughout the year. It means if the company is making profit, the 12-month profit, even if I divide equally, each month profit is same. So if the companies are making loss of 10 million, the loss of 10 million will be equally split over the month. But point here, what is period is only 6 months. So shall we take whole 10 million loss in our books or should we take only 6 months loss? Should we take full amount? Only 6 months. Exactly. So whole 10 billion loss is for the entire period. So post acquisition figure will be, I should take minus 10,000 into 6 divided by 12 because we only hold the company for a period of 6 months. So generally we do reporting minus acquisition gives you post acquisition. So this time I will take 81,700 minus 5,000. So on the date of acquisition, the balance of retained earning was 86,700. Is everyone understood logic with thumbs up 86,700? Why this time got added? Because the balance is reducing because of loss. Anyone has any question in 86,700, feel free to ask. Because we did every questions of consolidation, but opening was always a positive value because company had a profit. But this time because of loss, the balance is increasing. Sure, Supriya. So in this part, your return earning balance is 81,700. So return earnings is nothing but opening balance plus profit minus losses gives you closing return earning. So if the balance of return earnings on the date of reporting is 81,700, your company has made exactly 6-month loss of 5,000. It means on the date of acquisition, the balance should be higher by 5,000. So that if I take a balance of return earning on 1st July 86,700 minus 5,000 6 months loss, it should be 81,700. I hope it's understood now, Supriya and others as well. Sure. Once this part is done, I can take fair value adjustment. We got a fair value adjustment, $12 million. So on the date of acquisition, it is 12,000. Same figure would be appearing on reporting as well. So post acquisition will be reporting balance minus the acquisition. The balance is 0. But on this, there is a fair value depreciation. fair value depreciation. So rule says the fair value depreciation is for the period remaining of the life. Remaining life of this asset is 10 year. But again, I cannot charge depreciation for full entire year because the post acquisition period is only 6 months. So how do I calculate the depreciation? Depreciation always come on the reporting date because the balance sheet you prepare on last day of the year. So I should use minus sign. I will open the bracket. 12,000 is the fair value excess divided by 10 year is the life into 6 divided by 12 because the post acquisition is 6 months only. So we'll be charging depreciation of 600. Same figure will come minus 600 minus 0. The balance is minus 600. Everyone understood yes or no? Fair value adjustment plus fair value depreciation. Now, one adjustment is slightly different from what TYU we have discussed in the class is the fair value of investment. So subsidiary company has a total investment. Mayank, basically 12,000 is the excess fair value over the carrying amount. So rule says you need to depreciate only for remaining life. How much is the remaining life for the fair value adjustment? 10 year. So 12,000 divided by 10, which is the 1200 depreciation for 1 year. But our acquisition post period is only 6 months. So we'll take a only 6 months depreciation, which comes to $600. I hope that's clear. Chalo, great. Now we have a last adjustment, which is the fair value of shares as investment to subsidiary company. So if I look at the statement of financial position, subsidiary company has investment of 11,000 and this 11,000 investments fair value has increased by 3 millions. Aditya, no problem. I don't recollect exactly. You showed me the same question. Sure, no problem. Okay, so subsidiary has made a total investment of 11,000 and this has increased by 3,000 in the post. Increase in fair value of investment. Which is 3,000. Same will come here as well. 3,000 minus 0, which is same as 3,000. So I should make a total now. The net assets on acquisition 1,38,700. This total will. So we got a loss of 2,600 in the post acquisition column. So once we are done with working note number 2, I'll straight away move to the working note number 3. क्या लैग हो रहा है अंजलि? वीडियो लैग हो रहा है कि वॉइस लैग हो रहा है?
Both.
Both. 1 second. Am I audible now clearly? Sure, great. Okay,
सर
so that was. हाँ सागर.
एक बार वो इंक्रीज इन फेयर वैल्यू इन्वेस्टमेंट समझाओगे?
They have already given to you in the adjustment that there is a difference in the fair value of shares of parent and subsidiary both. So parent company have got a increase in fair value of the shares where I can show that adjustment. हाँ, over here. So both the companies have made investment outside the company and which is not designated as fair value through OCI. So that investment was measured at fair value through P&L. So parent company has made a gain in investment 15 millions and subsidiary got benefit of 3 million. Clear, Sagar?
ये तो ये अमाउंट कहाँ से आया 3 अच्छा वही ना मतलब
दिया है ना 3 millions.
हाँ
3 million का gain हुआ है.
यस
Sure. Sure. Then we'll go to the working note number 3, which is for goodwill. Fair value of consideration paid. In the first statement itself, they have given to us the fair value of consideration paid is $100 million. So $100 million, which is 1 lakh because our all the figures are in 1000 already. Fair value of NCI at acquisition. Fair value of NCI at acquisition was already given to us in the last adjustment, which is 29,000 on 1st July. Less fair value of net assets at acquisition, which is minus sign 1,38,700. Enter. And now we'll add and subtract net assets. Oops, we have a minus figure, which is called as bargain purchase. Now don't surprise in the exam, the figure can come negative as well. Now this time we got a negative, it means we acquired a subsidiary below market price. So bargain purchase will not come here in the non-current assets. Amount will be 0 here and this will come in the retained earning calculation. Everyone understood the calculation negative figure? Goodwill will become a positive here as a bargain purchase for parent company. So rather than recording under non-current asset, now this figure will come under working note number 5. There are very rare chances in the exam that you get a figure of goodwill as bargain purchase. So there are possibility you can have bargain purchase as well. Extraordinary gain nahi hai Bhavin. Bhavishya, sorry. This will be recorded under group retained earnings only. Working note number 4. Which is NCI, fair value of NCI at acquisition. I'll take the figure from here itself, 29,000. NCI post acquisition of share. In post acquisition, we made a loss. Loss is 2,600. NCI hold 20% share of the company, so into 20%, which comes to minus 20. So amount payable to NCI is 28,480. Once I get the figure, I can go up in the format in front of NCI equal to, scroll it down and press the value, enter 28,480. Working note 5, group retained earning. P's retained earning. How much is the retained earning for P? We have to check financial position. Parent company has retained earning of 2,14,300. 2,14,300. Fair value adjustment. Sorry, my bad. Fair value adjustment on investment. So parent company has invested whatever amount outside the company. On that, they also made a gain of 12 million. So if you want, I can show you again. Sorry, that's a 15 million. So parent will have a gain of 15 million. For subsidiaries investment, 3 million gain. For parent company, it's a 15 million gain. So 15 million will be recorded as positive value. We have a share of profit from company we acquired associates, Anglo company. Now, how much is the profit made by Angus company? Sorry, not Anglo. associate company has made a profit of total amount 6 million, but we cannot take the full 6 million profit because we control 40%. But again, you acquired a company on the same day when the subsidiary was acquired. So we acquired an associate company also for a 6 months period. So I can show you the calculation, how much profit we are supposed to take. 6 million is a profit into 6 divided by 12, and then I should multiply 40%. 6 million is the profit of the entire year into 6 by 12 because the post acquisition period of associate is also same as subsidiary, and don't forget to multiply by 40%. Enter. So we are getting a profit of $1,200. Share of Scottish, which is your subsidiary company. Subsidiary company has unfortunately made a loss in the post acquisition. So parent is entitled for 80% loss. So I should take into 80%. Till now, any question in working note number 5, feel free to ask. Everyone, yes or no?
सर एक बार वो शेयर ऑफ स्कॉटिश मेरा नहीं, मतलब मेरे को अलग आया इसमें।
कितना आ रहा है?
कुछ एक मिनट था। into
2,600 is a total loss. On that, parent will get 80%. So 80% of 2,600 is 2,080. Because
हाँ
520 you gave it to NCI, your share will be same amount as 2080.
तो पोस्ट एक्विजिशन का नहीं लेते
हाँ,
हम लोग 80%?
तो पोस्ट एक्विजिशन का तो 80% लिया, 2,600 into 80%.
मेरा फायदा, हाँ ओके।
And the last one is bargain purchase will come from working note number 3. So I should use is equal to minus because it's a gain for a company, 9,700. So total retained earning for a parent company is 2,38,120. I can go up in front of retained earnings equal. I can go down again and select the value 2,38,180. And in front of this, I'll mention this is working note number 5. So marker understand from where we got the number. So we are done with working note 4, working note 5. I just have to make working note number 6, which I used as investment in Angus, which is associate company. Working note number 6, investment in Angus. So now we have paid amount to associate company in two format. One is in form of cash and second is form of other than cash. So how much money we paid to associate company for acquiring? If you see adjustment number 3. Sorry, 3 is a loss one. Second one, on 1st July, P acquired 40% A by paying 30 million in cash. In addition, we are offering shares 30 million, $2.30 each. So we are paying 30 million in cash. So cash amount will be 30,000 plus we are giving shares 30 millions into 2.3, which comes to 69,000 plus share of profit from Angus. I can take is equal to, and I can select from working note number 5 itself, which is 1,200. There are no impairment loss on associate company. So total amount of investment is 1,200,000. Anyone, any question in working note 6, feel free to ask. हृदय किया ना ऐड मैंने 9700. Which fair value?
सर वो एसोसिएट का जो रिवैल्यू हुआ है 3 मिलियन।
Associate का नहीं हुआ है. That is between parent and subsidiary company.
ओके सॉरी।
ठीक है, no problem. चलो, so we are done with adjustment.
सर कैन यू शो दिस वर्किंग नोट नंबर 2?
वर्किंग नोट नंबर 2
हाँ
उस पे ही अटका है अभी भी।
नहीं हो गया, वो बाकी रखा, आप आगे चले गए तो मैं भी आगे आ गया फिर। और खाली पोस्ट एक्विजिशन। हाँ ओके, हाँ एक वैल्यू मिसिंग था। थैंक यू सर।
वेलकम। चलो तुम्हारे बेनिफिट के लिए आई विल मेक अनदर वर्किंग नोट 7। Working note number 7, which is for other investments. For this, I'll make a working note investment. Working note 7. P investment. S investment. Okay, now let me see the statement of financial position. How much is the investment of parent company? 2,97,000. How much is the investment of subsidiary company? 11,000. From parent company's investment, we need to subtract investment given to subsidiary company and associate company. Less investment in Scottish. So we paid how much money to subsidiary company? Acquisition was 100 million. So 100 million will be subtracted here by minus 1 lakh, because that's the same amount you invested in subsidiary company share capital. Less investment in Angus, which is associate company. How much cash we have given to acquire associate company is $30 million. So even this will be subtracted, $30,000. And there is a fair value adjustment. Fair value adjustment in shares. For parent company, it is 15 million, and for subsidiary, it is 3 million. So total will be 15,000 plus 3,000, which is 18,000. And now I should make a total which comes down to 2,95,000. Let me check. Did I miss something? Investment in Scottish, investment in Angus, and investment in shares. 1 second. Oh, sorry, it's 11,000. My mistake. Thank you, Hriday. 1,96,000. Correct. So other investment, I should take equal to, scroll it down. Which is 1,96,000. About non-current asset, let's check the balance of parent company's property, plant and equipment. Property, plant and equipment of parent company is 2,15,000 plus subsidiary it is 87,000, plus we made a fair value adjustment of 12 million in the working note number 2 and minus fair value depreciation, which is 600. This shortcut is allowed. Parent company 2,15,000, subsidiary 87,000, plus there is a fair value adjustment on non-current asset 12,000 minus fair value depreciation 600. So balance is coming to 3,13,400. Investment in associate company, we have already made a working note 6. I'll just scroll it down, working note number 6, and we got a figure 1,200. In current assets, we have inventory. So how much is inventory for parent company? 61,300 plus subsidiary has inventory 22,500. No adjustment on intra-group, any adjustments on inventory 83,800. About trade receivable, parent company has 37,100 plus subsidiary has 15,600. Now here there is an intra-group transaction between parent company and subsidiary company. So I'll again read the adjustment and I make sure that everyone understand properly. In the books of P company, the second last adjustment, Scottish and Angus have made sold each to other. None of the profits remain in the books. Parent company is showing payable amount of 5 million in Scottish, but this does not agree in receivable in financial statement of Scottish company due to 2 million made by P company on 31st December. So if I take a simple way as understanding, parent company showing 5 million is due because parent has already transferred 2 million. So can I say indirectly in the books of subsidiary, this amount is parked as receivable? Correct, everyone? 7 million. Because parent has already transferred 2 million amount to the subsidiary company, but subsidiary has not received the amount of 2 million because that is nothing but cash in transit. So subsidiary is showing an amount of receivable 7 million, but parent is recording payable of 5 million. Everyone understood? Anyone single question, feel free to ask by unmuting yourself. So from the balance of trade receivable, what figure should I subtract? What amount should I subtract from the balance of receivable? $5,000? Only one person? $3 million? Chalo, Rita is also saying 3 million. You people did not understand the adjustment it means. Subsidiary is recording 5 million payable to subsidiary company, but subsidiary has not received cash only first. So subsidiary is recording in the books of account as receivable 7 million. So I need to pass first journal entry, the cash in transit. So moment I pass the journal entry cash in transit, your receivable balance will decrease by 2 million. And then of course we have to do net off by the 5 millions of intra-group as transaction. So cash will increase by 2 million and subsidiary to be decreased by 2 million. So subsidiary has in the books of account 7 million. So I should subtract 2 million first here and then intra-group receivable will be cancelled out. 1 second. Bansri has asked the question 15,600. Which 15,600 you are asking?
Sir, in the trade receivables, there was 15,600. That one.
15,600. 1 second. 15,600 is the balance of subsidiary company receivable. It's given in statement of financial position. If you see the balance in parent company, receivable balance is 37,100. Subsidiary has total 15,600 receivable, but that includes 7,000 is due from the parent company. So that needs to be cancelled out. Sure, sure. In terms of cash, how much is the cash of the parent company? Parent company has cash 1,300. Subsidiary has 9,200 plus there is a cash in transit which is of 2 million. So cash will increase by 2 million further. So the total assets becomes 7,51,600. Equity share capital. Equity share capital will always be parent company shares. Parent company's total share capital is 2,70,000 plus parent has issued 30 million shares to associate company. So 30 million shares into nominal value $1. So this will increase by 30,000 into 1. So parent company's total share capital is $3 lakh. Don't forget, parent has issued shares in the post-acquisition period to shareholder of associate company. But these shares parent has issued at what price? $2.3 per share. Nominal value is $1. So anything excess of nominal value will be the share premium. So share premium will come separate calculation here. Sorry, I should take it down. Share premium. We are issuing 30,000 shares and on each share we are taking premium of 1.3 per share. So 1.3, still if you want I can show it in the bracket. 2.3 minus $1, which is the premium. 39,000 is the total premium company has received. About NCL, we don't have any adjustment. So what is a loan note of parent company? Loan note of parent is 78,000 and subsidiary is 5,300. 78,000 plus 5,300, which come down to 83,300. And last one is trade payables. Parent company 49,400, subsidiary 18,300 minus intra-group payables. From parent perspective, it is 5,000. Sorry, my bad. 49,400 plus 62,700. So total liability should match with total of assets. 7,51,600. Both the balances are tally. I can make it bold. Feel free to ask any question by anyone, either unmuting or by on message as a chat.
सर एक बार इक्विटी कितना आया इक्विटी?
Equity, it is 3 lakh. 2,70,000 plus 30,000.
Okay.
Mayank, you want me to explain the working note number 3 or you want to just see the calculation part of goodwill? Okay, no problem. So you are paid less amount to acquire the subsidiary company. Which intra-group adjustment, Nirjara? Okay, you can ask me by unmuting yourself.
Sir, I just wanted to ask that this 2 million is paid, but they have not yet realized, right, that it is
Parent
not.
company has already issued a check on 30th December. So parent is recording payable is 5 million. But of course, this balance is not matching with subsidiary company because subsidiary had a receivable of 7 million. You got the logic of this first?
Yes.
So now, first of all, we need to record the entry for cash in transit. So we debit cash by 2 million, we credit receivable by 2 million. So that's the reason first I subtracted from the receivable amount 2,000. You can see first I subtracted 2,000 because that's a cash in transit. So that amount will decrease receivable and same amount I added in the cash balance as well. So now both the companies have a same amount receivable and payable 5 million. And then it will get automatically cancelled out between payable and receivable 5 million.
Okay, sir. Thank you.
Yeah, welcome. Daksh is saying, sir, we could show bargain purchase as separate disclosure or it is necessary to adjust in return earnings. You don't require any disclosures. It's part of return earnings. It's a gain for the shareholder of parent company that you acquired subsidiary at lower price. You need to understand, Daksh, देख एक तो loss making company उठाई है. Even in the post period, your company has a loss. So that justify that you paid less amount. Sure. Chalo. Now last question is for 2 mark. So requirement A was consolidated statement of financial position. I can give the heading A part. And unfortunate part B also theory I have to type here only because they have not given any extra space for writing theory answer. So be comfortable in writing theory answer in the spreadsheet area itself. Okay. Explain the rationale behind elimination of intragroup balances and unrealized profit. 2 points I need to discuss. First is intragroup balance and second is unrealized profit. So first I need to answer that why are we eliminating intragroup balances? So I'll give the heading. Any balances due between parent and subsidiary must be eliminated as they are part of the same group. Any balances between parent and other entity not forming part of group will only be consolidated to show real balance of receivables and payables. So reason why are we subtracting? Because we don't want to show investor that same company has receivable, same company has payable. So it means you are paying to your own company. But we only wanted to show that what is the real balance outstanding is between parent company and company outside, which is called as third party companies as well. So I think it's fair enough for 1 mark. I should easily get 1 out of 1 mark here as well. And the next point I need to discuss about the unrealized profit. Any unrealized profit in inventory between parent and subsidiary must be eliminated as it's a part of intra-group adjustment and profit is not realized due to selling externally. Only realized profit will be shown in consolidated statement of financial position. For 1 mark, I think 1 point is more than enough so that you can easily get 1 mark. It's very easy to get 20 out of 20 in the exam. See, I took exactly 1 hour because I was calculating also and I was explaining also. But I think if you do it on your own, you can easily finish off this entire question in maximum 50 minutes of time. Trust me, take 45 minutes, but you need to make sure that you don't take more than an hour. Because in 90 minutes is exactly 1.5 hours. They expect you to do 2 questions of section C. Everyone understood part B as well? So I want each one of you to try the same question again, but make sure you try to finish it in approximately 45 minutes, but don't look at the solution directly. And there is one more question which I want you to try on your own, which is the next question, which is based on interpretation of financial statements. So I'll just read the requirement part, but we are not discussing entirely because I want you to take exactly 45 minutes and do it. So make sure that whenever you are trying this question, you take exact 45 minutes for the previous question and 45 minutes for this as well. Using information in note number 6, calculate basic EPS figure for our company on 31st December 19 and restated earnings per share for 2018. So 2 calculation you are doing, EPS for current year and restate the figures of last year. Calculate following ratio for Ray company for 31st December and also calculate for 2019. So 2 financial year you have 18, 19. You are calculating gross profit margin, operating profit margin, return on capital employed, excluding deferred income. So in your statement of financial position, if you have any kind of deferred income, you will exclude those income. Current ratio is again excluding deferred income and trade receivable collection period. So 1, 2, 3, 4, 5. 5 ratios, only 5 mark you have for calculation. And comment on performance positions of Ray company. Again, 2 words are important. Performance, P&L account, position is your balance sheet ratio, which is for 11 marks. I'll just quickly read about the case study of the company. Ray company is a service company office offering supporting and training to several large entities. They have given statement of P&L for the 2 financial year, followed by statement of financial positions. Under financial position, we only have inventory, trade receivable, cash and cash equivalents, share capital, premium, retained earnings, loans, deferred income, you have to exclude for the calculation part and commentary part. Trade and other payables, deferred income also ignore current income, which is 5,000. Current tax payable 2650. Adjustment says 1. Ray Company's director has left on 1st January 2019 to set up K Company's business direct competition with Ray Company to maintain its sales level. Ray Company reduced its prices by 5% and extended payment terms to significant customer. So whenever you discuss anything about performance, I told you last time also, start your answer commenting on sales. That sales is increasing or decreasing, because see here you have given 5% discount to your sales. Now, why are you giving discount to your sales? Because the director has left your company. And once your director is leaving your company, he's starting his own company. So automatically your director is giving tough competition to your company. And in order to survive in the market, we started to offer 5% discount. Now, how much is the sales last year? Sales last year, 2018, was 63,400. Considering current year sales, what should be the value? Use your calculator. 63,400 minus 5%. 63,400. Sorry, my bad. So if I make it here, 63,400 into 95%. My sales was supposed to be 60,230. But is your actual sales is 60,230 or below this? Your sales is below 60,230 because your sales has only reached 58,200. You should start commenting on this area. Now, reason the maybe major impact will come on the performance. Number 1, your director has left the company on the first day of financial year. And in order to remain in the industry, we started to offer 5% discount. But of course, when you're offering 5% discount to attract more customer, and if things has sold majorly on credit, the liquidity problem will arise to your company. So we started to offering 5% discount. I'll mark it important because I need to compare whether your actual sales has decreased by 5% or more than 5% fall. Extended payment terms to significant customer. So when you're offering extra credit to significant customer, automatically this will leads to liquidity problem for your company. K company runs some advertisement publicity criticizing the work of Ray company. Ray company began legal actions against the K company and received 4 million as compensation. And this was recognized in operating expenses. This is one-off transaction that your current year profit has increased by 4 million. But of course, this transaction was not there in the P&L of last year. So I need to recalculate what is my operating profit excluding this amount of profit. So if I go and check, my operating profit is 9,450. So now if I see the last year sales and current year sales is decreased significantly, but see the profit 3,350 becomes 9,450. Profit is almost 3 times has jumped, but the revenue is declining. The reason, first of all, 4 million profit is included into this. So if I reduce this 4 million, the profit will jump to 5,450. Now you need to think and answer what could be other reason your profitability might have increased. cost saving, less operating expenses. You have to be very precise about your example. Nirjara and Anjali, the moment you write all of the basic things, sale of any asset leading lower depreciation. Daksh, from where you got this example?
Sir,
Yeah.
taking into account the cost of sales amount from 2008 to 2009, there is a decrease. So with
Okay.
limited information, we can assume that the RECO might have sold any uh, tangible assets like a machinery, etc., which might have resulted in lower depreciation in calculation from 20x8 to 20x9.
Okay. So just do one thing. If you use your calculator, what percentage is gross profit margin last year? कैलसी पे कैलकुलेट कर ले क्विकली 38,750 डिवाइड बाय 63,400. आयुष नहीं वैसा मत लिखना प्रॉफिट मैनिपुलेशंस.
That is 61.2%.
61.2%. So if the profit is 61%, approximately 39% is cost of sales. And check it for the current year.
%70.5%.
70.5%. So मतलब मोटा मोटा 100 minus 70 is 29.5%.
Right.
Not a big difference, right? Cost of sales.
Yeah.
Hardly anything. But I can feel still the bigger difference is we are offering 5% discount. We don't require to making. So this might be reduction in cost. See, when you're offering discount, cost reduction में कोई impact नहीं होगा हृदय. Of course, margin पे impact होगा कि तुम्हारा profit margin decline हो रहा है वहां पे. So what I feel कि तुम्हारा जो director छोड़ के गया है. So don't you think because of that there is a cost saving also in the 2019? Because in 18 we paid the salary for the whole year and he's living on 1st January. So of course this is a bigger saving. The director is leaving your company and that's the reason there will be a big change in your operating expenses. See, operating expense last year was 35,400 and current year it is 31,600. It's declining. जबकि तुम्हारा सेल तो ऊपर जा रहा है. So we still require a breakup. How much was the salary of director was paid last year and how much is the savings the company is making in current year? I hope this example is clear to everyone. Exactly. Salary of director is a big game changer here. Because of that, your operator. Huh?
I'm mentioning that the operating expenses have reduced in current year. So then we have to write the reason that because we are not giving salary this year to director, that is why
We
the
need extra. You can ask for the additional information. How much was his salary last year in order to analyze correctly that how much savings exactly the company is making in order to generate more profit for a company. And plus we require a breakup of administration and S&D cost of last year and current year. So to understand if the promotion spent has been made correctly, whether this justifies sales for the company or not. Sure, Nirjara? Chalo, better indicator of profitability would be the cash flow reflecting profit from sales. Yeah, that could be also reason, Ayush. Okay, that was adjustment number 1. Adjustment 2 is also done. Ray Company received government grant of 20 millions on 1st January 2019 and maintain employment in the local area for 4 years on January 1st and recognized 5 millions against the cost of sales. Daksh, aa gaya tera answer? Your cost of sales has decreased by 5 million, but this cost was not in the last year because you received government grant in this year itself. Now, considering this figure, how much is the cost of sales in the current year? 17,150. But this was originally cost was 22,150. अब कंपेयर कर ले तेरा कॉस्ट ऑफ सेल्स पे कितना परसेंट है? You will do 22,150 divided by 58,200. Chalo, 38%. So you can imagine the cost of sales has increased as compared to last year. So if it is 38%, the profitability is 62% now. So profitability actually utna hai nahi, but because of subtracting the government grant from the cost of sales, we have increased our profit margins. But of course, it is not the true effort of your company. So we need to recalculate profit using government grant value and profit excluding government grant value. So that was adjustment number 3. Adjustment 4. Ray company reduced staff in 2019. See again an indicator operating cost is decreasing, but finance director believes that the government grant will not needed to be repaid in futures. Government inspector is also due to visit Ray company within a few months of reporting date to the assess if any grant must be repaid. Of course, we have to reassess the condition. If the grant conditions does not meet, this is going to be the future liability for a company. The loan notes are due for repayment in 5 years, but the bank renegotiated interest rate on 1st January 2019 following concerns had over the Ray company's cash flow. So we need to think about it. This is going to be liquidity problem, because if the bank is sitting on your head because they want to renegotiate the terms and condition, because if the banker feels your liquidity is declining, they will not wait for another 5 years. Now bigger problem will come to your company because you are selling more goods on credit basis. Your significant customer has started delaying the payment, and this will become a future challenge for companies to survive. So conclusion mein dalna, the reason we wanted to give tough competition to director, but we are putting problem in our company itself, that we are giving more credit to customer to survive in the industry, but this has caused adverse impact by banks' legal actions against our company in futures. And last is for EPS calculation. The EPS of the figure was correctly calculated to be 12.5 cents for the financial year 31st December 2018. They have made your life easy. Last year EPS is already calculated. You only have to calculate restated EPS of last year. On 1st March 19, Ray company issued 10 million new shares at market value, and cash received was issued to purchase new property on 1st September 2019. That shows proper utilization of funds because you are issuing shares for expansion of the company. There was a 1-for-3 issue of bonus shares, and our company's current year profit is 5.6 million. Will you try everyone? Both the question, the one I discussed, the previous one and the current one as well. So please make sure use a practice platform only and try both the question. If you have any disconnect, feel free to ask in the exam preparation group to be more precise. Anyone has any confusion, conclusion before I end for the day?